Good morning and welcome to the Post's MPC press conference. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, the 7th of October 2025, and today the Governor of the Central Bank of Kenya, who's also the chair of the MPC, will take us through the thinking of the MPC and some of the data that the MPC considered while making its decision. After that, you can come in with your questions, and the usual way that we do so is through the app Slido, www.slido.com. The meeting code is hashtag MPC1025. Now, a very quick reminder, and it's important, please make sure you put in your name and your institution as you're asking the question, your name and your media house as you're asking the question. Otherwise, we may have to leave out anonymous questions. But without further ado, welcoming the Governor of the Central Bank, who's also the chair of the MPC, Dr. Kamau Thuge.
Good morning, everyone. During its meeting on October 7, 2025, the Monetary Policy Committee decided to lower the central bank rate, the CBR, by 25 basis points to 9.25% from 9.5%. In taking this decision, the MPC observed that overall inflation is expected to remain below the midpoint of the target range in the near term, supported by stable energy prices and continued stability of the exchange rate. Although some central banks in the major economies have remained cautious in lowering interest rates, others, depending on their inflation and growth outlooks, have continued to ease their monetary policy. The average lending rates in the domestic market have continued to decline gradually, while private sector credit growth has continued to improve, though at a lower pace than is desirable. The revised banking sector risk-based credit pricing model, which will be fully operational by March of 2026, will improve the transmission of monetary policy decisions to commercial banks lending interest rates. The committee therefore concluded that there was scope for a further easing of the monetary policy stance, and this will augment the previous policy actions that were aimed at stimulating lending by banks to the private sector and supporting economic activity, while at the same time ensuring inflationary expectations remain firmly anchored and that the exchange rate also remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in December of 2025. The committee, while making that decision, also looked at global economic developments as well as domestic developments. In regard to the global economic developments, the committee noted that despite higher tariffs, global inflation is projected to decline in 2025 and 2026, mainly driven by lower energy prices and reduced global demand. The overall inflation is projected to decline from 5.6% to 4.2% this year, and a further reduction to 3.6% in 2026. The international oil prices have moderated due to increased production and subdued global demand, but have been volatile due to elevated global uncertainties. Looking forward, the oil prices are expected to remain moderate, mainly reflecting increased production by the OPEC Plus as well as the non-OPEC producers, and reduce global demand. The OPEC Plus countries announced on October 5th, 2025, that it will raise output by 137,000 barrels per day in November of 2025. The main risks to oil prices relate to higher tariffs and any supply disruptions from escalation of geopolitical tensions, particularly the conflict in the Middle East and the war in Ukraine. In regard to food inflation, inflation declined in September 2025 from 6.6% to 3.4%, and this was driven mainly by lower cereals and sugar prices inflation, but edible oils price inflation remained elevated, although even for the edible oil price inflation, there was a deceleration from 24.3% to 18%. Looking at some specific major economies, the inflation in these economies has increased modestly in recent months, and this has been because of higher food prices as well as the impact of the higher tariffs. In the case of the US, headline inflation rose in August 2025, partly due to the effects of higher tariffs on imports. Their core inflation held steady at around 3.1%. UK inflation remained relatively elevated in August at 3.8%, despite a decline in core inflation. Eurozone inflation rose slightly in September 2025 from 2% to 2.2% due to higher food prices, but core inflation remained relatively stable at around 2.3%. China's inflation has remained low, mainly due to weak domestic demand. Of course, the increase in inflation for these major developing economies does pose some policy challenges, given that their labor markets and unemployment has been increasing, and therefore some of them have have retained their policy rates unchanged to address the inflationary pressures. But of course, in the case of the US, where unemployment has increased quite significantly and the labor markets are quite weak, the Fed has lowered their policy rate, and it is expected that they will continue to lower their rates in the coming months. Turning to global economic growth outlook, the growth has remained resilient in 2025, supported by an earlier front-loading of exports to the US ahead of implementation of the higher tariffs on trade. There has also been an improvement in the financial conditions and strong consumer spending. Growth is projected to slow down in 2026, mainly due to higher effective tariff rates on trade. The table here is the most recent projection from the OECD Economic Outlook, the interim report that came out in September 2025. We are expecting the IMF World Economic Outlook, which will also have projections for global growth, to come out in the next 2 weeks. At that point, we'll see what the views of the IMF are in terms of the global economic outlook. But based on the OECD, we see a deceleration in global growth from 3.3% to 3.2% in 2025, and a further deceleration to 2.9% in 2026. In 2025, however, quite a number of countries will experience an increase in production, with perhaps the exception or noticeable exception of the United States, whose growth decelerates from 2.8% to 1.8%, and a further deceleration to 1.5%. That is also the case with China, that decelerates from 5% to 4.9% and a further to 4.4%. And finally, Russia, where the growth decelerates from 4.3% to 1% and further to 0.7%. For 2026, however, most of the countries will experience a slowdown in economic growth, largely reflecting the elevated trade policy uncertainties, including the higher tariffs. With respect to the global financial conditions, these have improved significantly as reflected in the recovery of major equity markets. And indeed, in the US, the S&P 500, the Dow Industrial Average, even as well as the NASDAQ are at levels that are the highest in quite a number of years. In addition, the Eurobond market, the yields have declined quite significantly since April, and specifically in the case of Kenya, we can see on the right-hand panel quite a significant reduction in the yields on our Eurobonds, and this was the impetus for the government to do a liability management in the last few days, actually, and we expect that transaction to be completed early next week. And this involves the liability management of a Eurobond, $1 billion Eurobond that will be falling due in early 2028. And so the liability management is supposed to deal with that and move the maturity date to either 7 or 12 years. So to summarize on the global developments and outlook, inflation in the major economies has increased modestly in recent months. But global inflation is projected to decline both in 2025 and 2026, mainly on account of lower energy prices and reduced global demand. Although some central banks in the major economies have remained cautious in lowering interest rates, others, depending on their inflation and growth outlooks, have continued to ease their monetary policy. Global GDP growth has remained resilient in 2025, but is projected to slow down in 2026, mainly due to higher effective tariff rates on trade. The global financial conditions have improved significantly, as reflected in the recovery of major equity markets and the decline in Eurobond yields for emerging markets and developing economies. Risks to the global growth outlook remains elevated due to higher tariffs on trade, elevated trade policy uncertainty, weak global demand, and heightened geopolitical tensions in the Middle East and the Russia-Ukraine conflict. Turning to domestic macroeconomic developments and starting with overall inflation, the overall inflation increased from 4.5 to 4.6% between August and September. And of course, this is still below the midpoint of our target range of 5 plus or minus 2.5. And the main reason for the increase in the overall inflation was the increase in non-core inflation, which increased from 9.2% to 9.6%. In the meantime, core inflation declined from 3% to 2.9%. And as a result of that, the contribution of overall inflation by core inflation remained stable at 2.9 percentage points, but that of the non-core inflation rose from 1.6 to 1.7 percentage points. The main drivers of non-core inflation, we have the three key elements of non-core inflation, which are food, energy, and transport. But the main driver for the high inflation of the non-core inflation is really select vegetable items, and in particular tomatoes, carrots, onions, and cabbages. In respect to the core inflation, the main driver has been lower prices of processed food items, and in particular maize flour. Looking forward and looking at the projections over the short term or the near term, We see the inflation outlook somewhat improved compared to the last time we met, and we do see that overall inflation remains below the 5% midpoint of our range throughout the near-term projection. Our previous projection had indicated the inflation exceeding the 5% to around 5.2% in 1 month. But the prospects now, we see prospects much improved compared to the previous projections. In terms of the inflationary expectations, particularly of the private sector, the September 2025 Market Perceptions Survey, as well as the Agricultural Sector Survey, show that inflation expectations remain firmly anchored within the 5 plus minus 2.5% target range in the near term. In regard to the agricultural sector survey, inflation expectations, and in regard to inflation expectations in the next 3 months, 51% of the respondents expect inflation to increase, whereas 49% expect inflation to decline or remain unchanged in the next 3 months. This is an improvement over the previous survey of July, where 62% expected inflation to increase, whereas 38% expected a decline or the inflation to remain unchanged. The respondents to the September 2025 Agricultural Sector Survey expect the onset of the harvest season for key crops, particularly maize, and the stable fuel prices and the stable exchange rate to support stable inflation. Nevertheless, a majority of respondents expect higher prices of some food items, particularly vegetables, to exert moderate upward pressures on inflation in the near term due to seasonal factors. In regards to the market perception survey by the banks and non-banks, the inflation expectation in the near term is also remains well anchored within the target range, and this is again on account of stable international oil prices and a stable exchange rate. To summarize on developments and outlook for inflation, the overall inflation at 4.6% in September remained below the midpoint 5%. The overall inflation is expected to remain below the midpoint of the target range, that is the 5%, in the near term, and this will be supported by the expected onset of the harvest season for key food crops, particularly maize, stable energy prices on account of lower international oil prices, and the continued stability in the exchange rate, which is expected to continue to moderate prices. The September 2025 MPC Market Perceptions Survey, as well as the Agricultural Sector Survey, both show that inflation expectations remain anchored within the target range in the near term. And the main risks to this inflation outlook relate to uncertainty regarding weather conditions, higher tariffs on trade, and worsening geopolitical tensions, particularly the war in the Ukraine and also the conflict in the Middle East, which could have implications on the volatility of oil prices. Turning to domestic economic growth, the growth is expected to pick up in 2025 and in 2026, supported by a continued resilience of key service sectors and agriculture, as well as the continued recovery of the industry sector. Specifically, the overall real GDP growth is expected to accelerate from 4.7% in 2024 to 5.2% this year, and a further to 5.5% in 2026. And this increase in growth will be supported by the agricultural sector, which is expected to, the growth is expected to remain strong, reflecting the favorable weather conditions and the government program of subsidized fertilizer and irrigation expansion. It will also be supported by the industrial sector as it continues to recover, and in particular the mining and quarrying, which showed a decline in value addition of minus 9.2 in the whole of 2024, but we have seen a very strong recovery in the first 2 quarters of this year, with mining and quarrying increasing by 10.8% in the first quarter, followed by an increase of 15.3% in the second quarter. Similarly, for construction, which contracted by minus 0.7 in 2024, we had a strong recovery in quarter 1, it grew by 3%, and an even stronger recovery in quarter 2 of 5.7. We also expect the services sector to remain strong, supported by the continued digitization of the economy and the easing of cost of credit. The improved uptake of credit across key sectors is expected to support growth, particularly for building and construction, manufacturing, consumer durables, and trade. So the growth in credit to the key sectors of the economy, as I just mentioned, we can see that in regard to the manufacturing sector, a recovery in credit demand. There it was minus 14% in the same time last year, September 2024, and now we see an increase by 11.1% in September of 2025. Similarly, for trade, we see still a positive demand for credit. The building and construction sector, there's been a very significant increase in credit to that particular sector, and as of September, we see an increase in credit there of about 53%. Consumer durables also increased credit there, peaking at 12.2% in September of 2025. So looking at the surveys, the CEO and the market perception surveys, these surveys reveal sustained optimism about domestic business activity as well as economic growth prospects for the next 12 months. In regards to the commercial banks, and in terms of their perception about growth for the next 12 months, we see that 85% of those that who responded were optimistic about growth prospects for the next 12 months, and only 15% were pessimistic. With regard to the non-bank private sector, again there we have 10% who are very optimistic about growth prospects, and another 64% were optimistic about the growth prospects for the next 12 months. That is almost about 3/4 of those who responded. With regard to the CEO's survey, still on prospects for the Kenyan economy for the next 12 months, 42.6% thought the economy prospects would be higher. About a similar percentage of 42.6 felt the prospects would be the same, and only a small percentage of 14.7 thought that the prospects would be lower. The optimism was attributed to improved agricultural production, supported by the favorable weather conditions, the stable macroeconomic environment with low inflation, stable exchange rate, and declining interest rates, and a resilient performance of tourism as well as the digital economy. Nonetheless, some respondents expressed concern about subdued consumer demand, high cost of doing business, and increased global uncertainties attributed to higher tariffs and geopolitical tensions. To summarize the domestic economic growth, the economy remained resilient in the second quarter of 2025, and it grew by 5% in the second quarter compared to 4.6% the previous year, same time. And this was supported by a recovery in the industrial sector, continuing resilience of the services sector, and stable growth of agriculture. Leading indicators of economic activity point to improved performance in the third quarter of this year. Real GDP growth is projected at 5.2% in 2025 and 5.5% in 2026, and this will be supported by continued resilience of the key service sectors, strong performance of agriculture, and the continued recovery of the industrial sector. The MPC surveys conducted in September revealed sustained optimism about business activity and economic growth prospects for the next 12 months. This outlook is subject to risk, including higher tariffs on trade, elevated trade policy uncertainties, heightened geopolitical risks, particularly in the Middle East, and uncertain weather conditions. Turning to monetary policy implementation framework, as you all know, we've moved to an inflation targeting framework where the operational target is to ensure that Kesonia, or the interbank rate, closely tracks the policy rate, the CBR. And as you can see there, we have continued to refine this monetary policy framework in several ways. One is the corridor around the CBR, as can be seen on the left-hand side. You can see the corridor was quite, the corridor that is in gray was quite high. It was 250 basis points, plus or minus the CBR. And you can see the CBR going up when we were tightening monetary policy, and you can see it going back down to where it is now at 9.5. Well, that is what is shown there. Kesonia, the interbank rate, which is our target variable, did not really track the policy rate at the beginning of this framework. And you can see there's a difference, and it's very volatile. The Kesonia is quite volatile. But with the refinement of this framework, we can see that towards the end, first of all, the corridor around the CBR has narrowed significantly. It's only 75 minus or plus 75 basis points on either side of the policy rate. And now you can see that Kesonia closely tracks the CBR. They are almost virtually the same, and this will be very important as we move to the next model in terms of ensuring stability, not only in terms of the short-term rates, but also in lending rates by the commercial banks. So implementing that monetary policy in that framework, within that framework, we've seen the short-term interest rates decline, and they declined further in September 2025 from a peak of between 16 and 17%. We now see that the 91-day Treasury bill is below 8%, and the 182-day T-bill is around 8%, and then finally the 364 Treasury bill is around 9.5% from a peak of around 17%. And with that reduction in short-term rates, we've also seen commercial banks lending rates decline, and they've declined from a peak of 17.2% in November of last year. And with the continued easing of monetary policy, we've seen lending rates decline all the way to 15.1%. Similarly, the deposit rates, the average deposit rates have declined as the cost of funding has reduced, but we do see that the average deposit rate has declined at a faster pace than the lending rate. And with the reduction in the interest rates by the commercial banks, we've seen a fairly noticeable recovery in credit to the private sector from a negative 2.9% in January of 2025 to a positive of 5% in October 2025. And with the expected continued reduction in lending rates by commercial banks, we expect credit to the private sector to continue to increase in the next months or so. So to summarize monetary developments, the Kesonia is the Kenya overnight interbank average. The operational target for monetary policy has continued to closely track the CBR. The short-term interest rates have declined further in line with the recent reduction in the CBR, and reflecting the lower lending rates, credit to the private sector has risen from minus 2.9% in January of 2025 to 5% in September of 2025. Commercial banks' average lending interest rates declined in September 2025, with a decline in short-term rates expected to transmit further into lower lending rates and improve lending to the private sector. Turning now to the overall balance of payments, we project surpluses in 2025 and in 2026, mainly because of the surplus in the financial and capital account, which is expected to more than finance the current account deficits. For 2025, we are expecting current account deficits of 2.4 billion. That is the top line, the second to last column from the right. So the current account deficit is projected at 2.4, and going down to item B, you can see that the financial and capital accounts projection is for inflows, financial inflows of about $3.1 billion, and that should result in an overall balance of payments surplus of $674 million. For the coming year, 2026, the current account is expected to widen slightly to about $2.7 billion. But again, there will be sufficient inflows in the financial and capital account of about 2.9 to again facilitate an overall balance of payment surplus of about $229 million. So the current account deficit was 2.1% of GDP in the 12 months to August of 2025, and this was compared to 1.6% of GDP in a similar period in 2024. And this mainly reflects imports of intermediate and capital goods, and however, the current account deficit is expected to stabilize between 2025 and 2026, where it will, for 2025, we are projecting it to be minus 1.7 and at minus 1.8% of GDP in 2026. In regard to exports, goods exports increased by 3.6% compared to a similar period in 2024. This is the 12 months to August, and this was due to higher domestic exports, which rose by 8.5%, driven by horticulture, coffee, manufactured goods, and apparel. For this year, we are expecting exports of goods of 5.1%, and but for a recovery in 2026 of 10.3%. In regard to imports, total imports increased by 9.2% in the 12 months to August, and this mainly was due again to the importation of intermediate as well as capital imports, and in particular machinery and transport equipment. For this year, for the calendar year, this year we expect imports to increase by 8.7%, and this will be followed by another increase of 7.9% in the year 2026. Regarding the services receipts, these increased by 10.6% in the 12 months to August compared to the 12 months to August of last year, and this was mainly driven by increase in travel receipts, which increased by 17.8%. For this year, we are projecting an increase in services by 6.3%, followed by 10.1% in 2026. In regard to the tourism sector and tourist arrivals, so far, from January of this year to August, compared to the same period last year, we've seen an increase in arrivals of 5.5%. This is somewhat of a slowdown compared to the experience last year, where we experienced an increase in tourist arrivals by 14.6%. Diaspora remittances inflows have remained resilient despite increased global uncertainties. This has been supported by diversified source countries and impact of government policies to export skilled labor. The remittances for January to August have recorded a 4.1% increase. For the 12 months to August, an increase of 9.4%. And then for the calendar year, we do expect remittances to increase by 6% this year and a further 6% in 2026. So reflecting the strong performance of the balance of payments, the foreign exchange reserves have increased significantly and continue to provide adequate cover and a buffer against short-term shocks. The expectation is at least the number for As of October 2nd, we've seen the international reserves amounting to $10.7 billion. This is compared to the end of 2024 when we had $9.3 billion. And again, this is the highest level of reserves that we have had, and is equivalent to 4.7 months of import cover. And as I said, it is sufficient, it's an adequate cover and buffer against any expected domestic or even external shocks. The Kenyan shilling has remained stable, supported by diversified foreign exchange inflows from diaspora remittances, horticulture and tea exports, and offshore banks investing in government securities as well as in the stock market, as well as confidence in the economy, particularly with the recent upgrade of Kenya's credit rating by Standard & Poor Global Ratings. The expectation is that this stability will continue given the momentum in the balance of payments and the narrowing of the current account deficit. In terms of market sentiment regarding the exchange rate, the September MPC Market Perception Survey shows that the exchange rate of the Kenyan shilling against the US dollar is expected to remain stable. In regards to the commercial banks, 76% felt that the exchange rate would remain unchanged, and then there was another 12% of banks who thought that the shilling would strengthen slightly. With regard to the non-banks, private sector, 62% of them felt the exchange rate would remain unchanged, and 23% strengthen slightly, and 2% to strengthen. So of course, some respondents expect some moderate pressures, mainly arising from the increased imports. So to summarize on the balance of payments development and outlook, the current account deficit was 2.1% of GDP in the 12 months to August of 2025, and this is compared to 1.6% in the previous year. And the reason for this widening is because of higher imports of intermediate as well as capital goods. The current account deficit is projected to stabilize and to at 1.7% this year, 2025, but to increase just slightly to 1.8% in 2026, again due to continued growth in goods imports, even as there is resilience of exports, growth of exports, as well as diaspora remittances. The deficits, both of these deficits in 25 and 26 will be fully covered or financed by capital and financial inflows, and we should have balance of payment surpluses in both years that will support us to build international reserves further. The downside risk to the balance of payments outlook is worsening geopolitical conflicts may create commodity price disruptions. Persistent and elevated trade policy uncertainty could impact export-intensive industries, and of course the volatility in international oil prices. Turning to the banking sector developments, the capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20% respectively. For total capital adequacy ratio, it stood at 20.1% in August of 2025, and this is compared to 20.4% in June of 2025, and of course compared to the statutory limit of 14.5. In regard to the liquidity ratio, it stood at 59.8% in August of 2025, compared to 58.4% in June of 2025, and again compared to 20% minimum statutory requirement. The ratio of gross non-performing loans, the NPLs, to gross loans was 17.1% in September of 2025, and this was down from 17.6% in June and August of 2025. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, therefore providing sufficient buffers. The revised banking sector risk-based credit pricing model, which will be fully operational by March of 2026, will improve the transmission of monetary policy decision to commercial banks, lending interest rates, and enhance transparency in the pricing of commercial bank loans. In regards to fiscal developments, the expected fiscal consolidation over the medium term is expected to reduce debt vulnerabilities while moving the debt to GDP ratio towards a stronger, sustainable position. So to summarize the presentation and the key takeaways, on the global front, inflation has increased modestly in recent months, but is projected to decline both in 2025 and 2026 on account of the lower energy prices. Growth has remained resilient in 2025, but is projected to slow down in 2026, again on account of higher tariffs, impact of higher tariffs on trade. On the domestic front, the overall inflation remains well anchored within the target range. The Kenyan shilling exchange rate vis-a-vis the dollar remains stable and is expected to remain stable. The interest rates have continued to decline, which should continue to support growth in credit to the private sector and improved economic growth prospects. The revised risk-based credit pricing model, which will be again fully operational by March of 2026, is expected to improve transmission of monetary policy decisions to commercial banks' lending rates and enhance transparency in the pricing of loans by the commercial banks. And finally, with the stability in prices and the exchange rate, the CBK has continued to support the government's economic growth objective, as reflected in the further lowering of the central bank rate. Just before I conclude, we are having, just to brief you on the update you on our discussions with the IMF. We have been having the IMF visit with us for the last 2 weeks. Their mission comes to an end tomorrow. We are continuing discussions with a view to having a program. The discussions will continue next week when we go to Washington, and of course we would hope to reach agreement on a funded program as soon as possible. Thank you.
Thank you very much, Governor. That is the Governor of the Central Bank, who's also the Chair of the MPC, and he has actually preempted the first 2 questions. The first one from Kefa Mororia from the Nation Media Group, who was asking exactly about that, which is the IMF discussions. Is Kenya expecting a funded or unfunded program from the IMF under the ongoing discussions? And what can we expect from the current staff visit, which concludes October 9th? Same thing as Giorgio Bulutza from Reuters. How are the talks with the IMF for a new program going? I think that those two questions have been answered just now. Continuing, Ramanyang from CGTN Africa, who asks, after Eurobond refinancing and reprofiling of China Exim Bank loans, are there other loans targeted in liability management operations, for example, loans from the TDB? David Habling from Bloomberg News is asking, what explains CBK's plan to buy a retail bond system, yet it already has DAO CSD? Would an upgrade of the DAO CSD platform to have retail and mobile money capabilities suffice?
Wallace is right. I think I've answered the question on regarding the IMF. But then, just to emphasize, it's our expectation of to get a funded program. The question by Rama Yang is on whether there are other loans targeted for liability management operations, e.g. the TDB loans. As of now, I don't believe that we have moved in that direction yet. But liability management is part of the government's instruments of trying to smooth out debt service payments and avoid any kind of liquidity risk. But as of now, there's nothing on the table, as far as I know, about liability management, especially on external loans. David Habling, we are not buying a retail bond system. It will operate on the platform, the DAO CSD platform. So I think the short answer to that question is that no, we are not buying a new retail system. The Emma Kiba will be operating on the DAO CSD platform.
Thank you. The next set of questions will begin with Anna Nanjala Wekesa from the Kenya Times, and she's asking the same question that Julian Zamboko from NTV is asking. In order, is there any bank that has begun implementing the new Kesonia-based risk-based credit pricing model introduced by the central bank? And Julian's is of a similar note. Are there banks that have already commenced pricing new loans off Kesonia by the new regime in this transition window ahead of December the 1st? A related question as well from Fortune Ochako, who is a financial analyst at Money Academy KE. Fortune asks, with banks urging further CBR reductions, how will CBK ensure rate cuts translate to affordable loans for SMEs without fueling non-performing loans? Finally, in this set, Stella Swake from Kingdom Securities is asking, what is the central bank's observation of overall demand, and to what extent would you say that low inflation is reflective of muted consumer demand?
Yes, indeed. I think the questions from Wekesa and Amboko are somewhat similar, as well as Ochako. As we indicated, the framework of the new risk-based credit pricing framework, there were two different timelines. One was for new loans, in which case we said that any new loans should be subject to the new framework, and we do expect that the commercial banks will come back to us within the 3 months plus the 2 weeks allowed with the frameworks for the new loans. For the existing loans, variable interest loans, the expectation was that by March of 2026 is when they would start with the existing loans. We have a technical working committee comprising of the central bank as well as the industry, and we're working to ensure that these frameworks are approved by the boards of the particular banks as soon as possible. And as I've said in the past, I think it's to the advantage of the fast movers, those banks who move quickly to adopt this new framework. I think Kenyans will be interested in the transparency and in ensuring that whenever the central bank takes a policy decision, that policy decision is quickly reflected in their lending rates. And therefore, I do believe that for banks that are moving quickly in that direction, it is actually positive for them, even from a business point of view. We do have one bank that has already submitted to us, but again, as I said, we are expecting we have given the banks the 3 months for the new loans and 6 months for the existing loans. The Ochako, I think I've already, with regard to the CBK ensuring that rate cuts translate to affordable loans for SMEs without fueling NPS. The new framework is exactly supposed to address this particular issue. What we have seen in the past is the banks were quick to raise rates when the CBR went up, but weren't as quick to lower their lending rates when the CBR came down. And therefore, this new framework, where we have a common reference rate for all the banks and for all variable rate loans, which is the Kesonia, will automatically imply that every time we lower the policy rate and then undertake the monetary policy operations to lower the Kesonia to the new level of the policy rate, that immediately the Kenyan borrowers from the banks will experience immediate reduction in their interest rate. That is the intention of this new policy framework. There's a question on the CBK's observation of overall demand and to what extent we would say that low inflation is reflective of muted consumer demand. I do think, I think as my presentation showed, the core inflation has declined from 3% to 2.9% in September. And that, to a certain extent, does imply that there is less excess demand in September compared to the previous month. It may also reflect the fact that there has been, as I said earlier, the economy has expanded quite well, I think. The second quarter, the economy grew by 5% compared to 4.6% last year. So it can also be seen that there is a supply. The supply has increased, and therefore we see the muted, or rather we see the reduction in the core inflation, which really is around that measures the excess demand, as opposed to the non-core inflation, which fluctuates for reasons other than either monetary policy decisions or fiscal policy decisions.
Thank you. The final couple of questions going back to Ramanyang of CGTN Africa, who says leading indicators point to a recovery in lending and private sector activity, which the governor has just spoken about. But the question is, was this recovery at risk of stalling without the 25 basis point cut on October 7th? And finally, from Jimmy Mbogo, Jimmy is from Royal Media Services. Can the governor speak to what is happening in the labor market, job creation, and how that could impact the growth of the economy?
I think, Rama, I think we felt it was important to continue this momentum of reducing the policy rate. I think in our view, even though credit to the private sector has recovered, as I said, from the minus 2.9 in January to 5% in September, we still think that there's some ways to go in terms of really sufficient expansion of credit to the private sector. And therefore, the 25 basis point is still to ensure that banks continue to reduce their lending rates so that we can move to even credit expansion to the private sector beyond even the 10%. And so, so our view is that the conditions, when we look at core inflation, especially the declining core inflation, when we looked at the fact that the overall inflation was still below the midpoint of the 5%, when we looked at the fact that the exchange rate has remained stable and that we have a significant buildup of reserves, we felt that there was still scope to ease the CBR by the 25 basis points in order to encourage the banks to lower their rates, and so that credit can expand and we can have more growth. And again, maybe perhaps related to that, and to answer Jimmy Bogo's question, the whole idea of lowering the CBR was to stimulate credit to the private sector, which in turn stimulates economic growth, which in turn improves the labor market in terms of improving on employment. So yes, the whole idea is let's stimulate credit to the private sector, let's stimulate growth, and let's have an increase in employment. We may not have the specific data on the labor market, but the intention is ultimately to have more employment and to reduce the unemployment rate.
All right, thank you, Governor. That brings us to the end of this session, the post-MPC press briefing. As a reminder, the MPC met yesterday and made its decision, and there shall be quite a number of items shared. These include the full reports from the MPC surveys, that is the CEO survey, the market perception survey, and the agriculture survey. They have a lot more dense information that you can interact with. But in the meantime, the MPC plans to meet again in December, and so after that meeting we shall have this session. But in case the MPC would like to meet before, as is usual, we shall let you know in good time. But for now, thank you very much for being with us, and do have yourselves a good day.